Welcome to another episode of our Do More With Your Money show. I'm delighted today to be joined by three members of the investment team, Faye, Seb and Kevin. And what we're going to do is just really reflect on how asset markets have reacted to the election in the US. And certainly it's been a very interesting period for markets from a political perspective as well. But really for us, it's how does that impact asset markets? And I suppose, Kevin, for you to start the conversation, we've had this happen before, Trump getting elected. Markets reacted in potentially different ways to different events. Can you maybe compare and contrast how we see asset markets today versus Trump's previous incarnation?
Absolutely. So, but if we go back to 2016, the election of Trump was taken well, and it was unambiguously good for all equity markets. And in fact, we often focus back then on how well the US equity market did, but world equities did better. So Europe outperformed the US for the first 6 months, and emerging markets did incredibly well, fueled by China. It's different this time round. So the US has done very well. It was up 5% last week, and the S&P 500 went through 6,000 briefly at the close on Friday. But European equities are down, UK equities are down, and Chinese equities have given back some of their gains. And that really reflects a more serious concern about some of perhaps the tariff and trade policies from the Trump presidency this time round, because he's more of a known quantity, and I guess he carries more credibility with regards to tariff threats, because in effect, that's what he did in the last half of his first term. So equity markets have done well in the US and Japan, but not so much in Europe and in China. And bond yields have gone up, but bond yields were going up well in advance of Trump. And that's largely a reflection of optimism on global growth, and that the worries we had in the summer, the markets had in particular with regards to US jobs slowing, proved to be short-lived, and the US economy continues to grow strong. So we've seen bond yields are now back to where they were in the middle of the summer, really. But rate cuts are still expected, and we saw that last week with the Federal Reserve.
And does that sort of change a little bit about how the Fed might think about the future in terms of some of those broader economic policies that Trump has outlined? And how should we think about that potentially in the reactions that we've seen?
So I think the Fed will react and be wait and see. I think the market is doing a lot of the work for the Federal Reserve here, in that if we go back 7 weeks, expectations were interest rates in the US would fall from 5 to 3% by the end of next year. Now they just expect interest rates to fall to somewhere close to 4%. So markets are perhaps a bit more realistic in their expectations for interest rate cuts over the next year. But I think the Fed will take it as it comes and won't strengthen the political regime.
Do we see that most evident in the dollar at the moment, or where do we see that most evident?
I mean, the dollar has outperformed. It's and that's largely a result of US bond yields rising faster than the rest of the world. It's nothing too worrying. We've seen these types of moves. You see these types of moves typically every quarter, albeit for different reasons. So I think on the whole, markets have taken the Trump election quite well. It's been very positive for US equity holders and global equity holders. Bond yields have just have readjusted somewhat, but as we've seen from all of the central banks in the last couple of months, rate cuts are still on the agenda, and central banks do expect inflation to decline further.
So maybe you could expand out just a little bit on what you've been observing in a global context. Kevin's focused there on what we've seen in the US and in broader equity markets.
Yeah, the initial market response has very much focused on the negatives for the rest of the world. So the likelihood that, as Kevin mentioned, quite aggressive tariffs are implemented, and certainly the appointments that Trump has made so far point towards quite aggressive stance towards the rest of the world, both economically and perhaps in defence terms as well. So the impact on markets outside the US has been not so positive as in the US, because people are focused on the fact that imposition of potentially a 60% tariff on all Chinese goods would be quite damaging for Chinese exports, and potentially a 20% tariff on European goods could be quite damaging as well. I think probably we need to think about what the response of some of these areas might be to Trump tariffs. The two kind of key areas I think that could potentially have quite a forceful response would be China and Germany. We've seen over the last week or so that the German government has effectively collapsed. The coalition has collapsed, and there'll be elections early next year. And there is speculation that the debt brake that Germany has had for some time, the fiscal debt brake, might be abandoned. So that's a potential move.
That would be quite a step change in response to the situation that we're seeing.
Yeah, I mean, it is speculative at the moment. There's no confirmation that that's definitely going to happen. But what we could see is just a move away from the export-driven growth that has so upset Donald Trump, that Germany and China have both pursued towards trying to boost domestic demand, and both areas have the potential to do that.
I think it's quite an interesting point to maybe expand out for our listeners. How would one envisage that? From a Germany perspective, it could be quite positive from a broader European perspective as well. Yeah,
I mean, so German fiscal debt is about 65% of GDP, which sounds quite high, but is very low by international standards. And for China, it's more like about 80%. So both countries have quite low government debt levels relative to GDP. So there's a lot of scope for fiscal measures to try and boost domestic demand. We've already seen some measures announced in China to boost local government finances, which have been very damaged by the failure of the property market. But it's quite likely that we see further measures directly to boost consumers and households in China. I don't know what kind of measures are likely in Germany,
but it's an interesting
there's a lot of
topic
potential.
To think about what can be sort of released as we get more detail, and I suppose like anything in a political sense, it'll be a negotiation potentially as well in terms of, well, you move with tariffs and that way we'll be moving in this direction as well. I think that's really helpful to set the context, but it's also, I think, really important for our listeners to think about their multi-asset portfolios that we're investing in. There's multitudes of factors impacting them, and there's certainly been a lot more economic activity as well that's been of consequence, both when we look at here in the UK but also in the US. And Faye, I wonder, could you just bring out some of those key things that you've been looking at and discussing as an investment team?
Yeah, absolutely. So in the UK yesterday we had some jobs data out, so we actually saw a slight uptick in the unemployment rate, so that increased to 4.3 from previously 4%, so a notable increase, but important to note that it is actually still quite low compared to historic levels. And actually the UK economy did add jobs in the third quarter as well, so they added 220,000 jobs. Expectation was for actually a contraction in jobs, so positive and a positive for growth. So I suppose the question there might be, well, why did the unemployment rate increase if the economy is adding jobs? And it's really supply driven. You've had a bigger increase in the supply of workers compared to the number of jobs that have increased, but the labour market still remains very healthy overall. I think the other aspect as well, which is quite important for the Bank of England in respect of the labour market, is wages as well, just given its impact on inflation. And we've seen wages continuing to be quite sticky, really. So average earnings, excluding bonuses, increased 4.8% on an annual basis, so still outpacing inflation, currently about 2.4%, I think, in the UK. So I think that combination of labour market strength and then also just sticky wage inflation is, perhaps builds an argument for potentially slower pace of rate cuts for the Bank of England. But it's important to note as well that there is a slight reliability issue with some of the UK jobs data.
It seems to be an understatement.
Yeah, quite a bit. Well, I think the survey response rates have been quite poor, so it's important to, not just look at one data point and actually,
It's very much about the trend and how we're observing that trend over time. But you bring out an interesting point there. It was only a couple of months ago as a team we were looking at some of these reliability challenges and just looking at survey response rates and how across many developed economies how survey data has potentially become slightly more unreliable. It's slightly more difficult when you say that about the ONS. In terms of their data quality.
And we forget that so much of monetary policy is based off survey data.
Yeah.
It takes too long to gather the real data that these surveys are. Their accuracy is critical for the timely response of central bankers. And as Faye points out, with a very low response rate in the UK jobs data, which is a survey, the reliability of it is very weak. And in fact, the Bank of England have flagged this. I think the Bank of England are building their own measure, which they'll launch sometime next year. Because the ONS don't seem to have any way to build up the response rate again.
And I suppose there was the UK. We've also got today the US, the CPI number, which is also feeds into what Kevin was saying at the start about that direction and how the Fed might consider policy directions over the rest of the year.
Yeah, exactly. Just in the last hour, I think we've had US inflation. So US inflation, like other developed markets, has been on a downward trajectory. I think if you think back to summer of 2022, is at about 9%. Now you're looking, the number that's just come in is at 2.6%. So a slight increase from last time, just given higher shelter costs, but still in line with expectations and, a lot closer to target than we have seen in the past couple of years. If we look at core inflation, which excludes some of those more volatile components like food and energy, that came in at 3.3%, so unchanged on the month, in line with expectations as well. I suppose one thing we'll be looking forward to in the next couple of months as Trump enacts his policies is just the potential for slightly higher inflation maybe as a result of the tariffs imposed on imports to the US, just as companies pass through those costs on to consumers. But we wouldn't really expect a material tick up in inflation, but it'll be something that will be
something there that we'll have to
watch out
for, as you rightly say, and consider.
Yeah.
It is somewhat ironic when you hear Trump speaking about it that he doesn't think some of these policies are inflationary, but time will tell, I suppose, for all of us on that front. Maybe to also think about it through the lens of which, as a team, we engage with our managers. We've went through a couple of numbers of days with calls with our managers, and a lot for them to look at and assess at this point in time. Could Faye maybe think about just what have been some of those key points that we've been taking from those calls and just help our listeners understand why we're asking the questions that we've been asking as well? Yeah,
absolutely. So I think probably one of the main themes from the calls that we've had with our managers has been, well, in respect of the economy and also their market views, has been favour the US and then fund that through Europe, as we've been talking about. So obviously corporate tax cuts and deregulation, quite positive for US corporates, positive for earnings, so positive for US equity markets. And then on the flip side, you've got tariffs, as we mentioned, a potential headwind for Europe there. So I think one of the trades that really encompasses that is actually a trade that UBS put on, which is a relative value trade within equities, where they've chosen to go long the US and actually fund that through shorting Europe. And then within the US as well, they've added to both market cap and also equal weight, which has sort of a higher weight to those mid-sized, smaller companies, which are expected to be some of the key beneficiaries of those, tax cuts and deregulation.
It is fascinating, that point about how US earnings have the potential to move higher as a result of some of the policy changes that we see when we're already at very high levels of earnings relative to history, but also the margin structure of US businesses, which is also high relative to history, but has the potential to get higher.
Yep. And I think it's from very soon we start to get 2027 estimates for earnings. So 2024 is looking very strong. Expectations for 2025 and 2026 are very strong. So there's a lot there to be optimistic about. And building off something Faye mentioned there about UBS, one of the conversations with Pictet was this view, we keep thinking, or the market keeps thinking, US growth will actually slow eventually. But perhaps we need to consider that actually US growth now is structurally higher because of the fiscal policies enacted through with President Biden, likely to be continued to some extent through Trump. And so we should expect a higher level of real GDP growth in the US than we've been accustomed to post-GFC, and that maybe the disinflation trends that we've talked about and that Faye mentioned in wages, we don't need to see growth slow in order for that disinflation to continue. So there is a lot to be optimistic about, but it's mostly coming from the US.
And I suppose that is the point that we've been discussing here, but as Faye's highlighted with the managers as well. Incrementally, would it be fair to say slightly more concerned about Europe, or would that be too much to read into it?
Yeah, I think, well, with the tariffs, I think that potentially has more of an impact on Europe than, China's got potential stimulus measures that they can use to kind of combat that, but potentially a bit more of a challenge in Europe.
I suppose the optimistic take would be that this kind of forces Europe to take matters into their own hands and actually look after themselves. Yeah. Same for China as well. But that's probably a second round effect, and so markets and managers have initially concentrated.
And it probably brings back quite a bit of, or the potential for policy divergence from a monetary perspective that could have, for multi-asset portfolios and currencies, could introduce other considerations for ourselves and for our managers as well.
Yeah. And I think we have to be realistic. France has a split government. Germany doesn't have a government, and the way their process works are unlikely to have an election before March, and it could take 6 months for there to be a coalition agreement. And Germany isn't growing. Germany's had 4 or 5 quarters of zero GDP, and with the threat of tariffs, there's just this. We should expect this building uncertainty to be mostly manifest in European stock markets in particular.
And where does the UK fit in that then?
Well, I would say what my view is, what hangs large and looms large in the UK, is the budget, and that we've heard these messages more and more from retail-focused businesses. So, Marks and Spencer's last week, JD Sports this week, that the budget pressures, particularly from national insurance rises, are going to restrict their ability to hire, to grow, but are going to lead to price increases. So it's not a great combination for the UK stock market. Anyway, it does have retail names in there, but typically
it probably challenges the bank a little bit. Faye was saying, just about the sticky wage inflation backdrop.
That's the real issue, I think, for the second half of next year, which is if we start to see stickier wages in some parts, but also weaker jobs data. But of course, if we don't actually have any confidence in the jobs data right now because of the survey, then we're in a bit of a quandary. What do we believe? So I think the Bank of England might have an unenviable job 6 months down the road if they don't have a true feel for what actually is going on in the UK economy.
I think the bank's estimates for the impact of the budget on GDP and inflation was about 0.5% on inflation, a bit more than that on GDP growth. So that does probably limit the amount of interest rate cuts that the Bank of England can feed through. The market is still expecting several more cuts, but not as many as they were 6 months ago.
Maybe to start and bring some of this together, clearly we've talked about the impact of politics and policy and markets, how different areas have responded to that. But how does this influence the core view that we have as an investment team? How do we take that information, distill it down in, challenge our managers, challenge ourselves? Maybe just bring that process a little bit to life for our listeners.
I mean, one of the things that I guess developments have confirmed to do with our core view is really that strong nominal GDP environment, particularly for the US. I would say one of the challenges we've faced in recent weeks is we had expected growing global breadth of growth, and I would say that has been challenged by recent developments to some extent. As I mentioned, I do think the second round effects might be that Europe and Asia respond to Trump tariffs in a positive way for themselves, but that's some way down the line.
So that view is, I suppose, somewhat similar to that of of some of the managers as well, as Faye was bringing out. Managers really going more into the US in terms of the exposure that they want to have.
Yeah, I think so.
So all roads lead to the US at the moment.
Lead to the US, yeah.
What's the counter to that? What's the challenge to that?
I suppose that the counter is the potential for significant further stimulus in China could actually turn around the kind of decline that China's been in economically and market-wise for some time. There's kind of different things going on in Japan as well. So there's ongoing corporate reform story, which is a kind of tailwind for Japanese equities. So there are some kind of glimmers of hope outside of the US.
I just wanted to bring that out because that's part and parcel of what the team do when they're challenging our managers. It's, well, what is the counter to that view that you've got, or the North Star that they do have?
I think it's interesting as well, actually. Allianz, we talked to them yesterday. They actually talked about adding to China. So it might seem quite surprising given the tariffs that you've got in China. But they've been mentioning, because it's so well known, it's already in the price. And they potentially have more ability to react to those tariffs as well with stimulus measures. So they've actually taken the opportunity to add to China.
Okay, and I think there is one ray of light for Europe is, and it may not be a ray of light for Ukraine, but as if President Trump uses the military might of the US to force a détente between Ukraine and Russia, whatever that looks like, if there's an end to that conflict, it should be of benefit to Europe. There could be a release valve through lower oil prices perhaps, and perhaps just a better political mood. It wouldn't come without problems, obviously, but perhaps one of the shadows which has been cast across Europe by Russia's invasion of Ukraine, if that was to reach some form of treaty-based conclusion, then perhaps Europe can prosper most from that. So there's a ray of light there, perhaps.
And I think that's where we're very lucky to be involved in markets. It's that intersection between politics and how that's actually reflected into asset prices that we look at and invest in. Okay, well, thank you very much to the team, to Faye, to Seb, to Kevin, to taking us through their thoughts on what's been happening post-US election in markets, but also, I think, critically reminding us all that there is much else going on in the world, that we shouldn't just focus in on one headline at this point in time. Thank you very much.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.